Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone. Thanks so much for tuning into the Millionaire Next Door podcast. We're really glad you're here. We hope you're getting value out of this, so please like and share it. We're recording this. It is April 14th of 2025. It's definitely a very interesting time with kind of historic, very high levels of volatility, a lot of on and off tariff discussions, a whole lot going on. There's also a really high level of anxiety and sort of concern and worry I'm hearing from clients and folks in general, but just wanted to continue discussions. We have a guest today who's going to be absolutely terrific, Strider Elass. He's a Senior Economist with First Trust. He does a terrific job. We had him out at Pasadena, California to a chop house, actually, to talk to our clients about 5 years ago. But Strider, welcome. Thanks for being here.
Robert, thank you. It's a real pleasure to be with you.
Yeah, for sure. And these are really interesting times, wouldn't you say, even from a perspective of looking at a lot of decades of data? Your thoughts?
Definitely. It seems almost every day there's some new worry out there or something new going on, and definitely volatility like we haven't seen in a long time. I mean, a market that goes down 5% in a day, up 10% in a day. I mean, it's pretty incredible.
It really is. So we've been parsing the data quite a bit and trying to come up with some of it's just sort of shoot from the hip stuff, but there's some other reasons. I'm curious, why don't you share your thoughts now, what's happening, maybe not so much rehashing the past, but where is the puck heading, or any thoughts you're sharing with your folks these days and within your economics team?
Yeah, sure. I think it's important to start how we got to where we are today. And so much of that, I think, goes back to the period of time of really the shutdowns that occurred back in 2020 and really the policy decisions that were made over that period of time. You think about what the Fed did. They cut interest rates to zero. They provided liquidity to basically any sector that needed it. And they embarked on quantitative easing 4. Now, if you think about what happened over this period, we added trillions of dollars of spending to the economy. I mean, the stimulus was like nothing that we had ever seen before in history. And the policy accommodation, then add on to it the massive deficits that we've been running over the last couple of years that have been about 7% of GDP. What we haven't seen in a non-war, non-recessionary environment, put that all together, and it's led to this stimulus-driven last couple of years, which has been massive returns. But what we've been saying, and we were one of the few coming into this year that actually was negative on the market and really on the economy too, was that there has to be a payback period for this. And we think what we're going through today, whether it was the tariffs that started this or not, was that we were going to go through a payback period, and that we believed it was going to be this year, and that seems to be what we're starting to hit. Now, no matter if President Trump was elected or Vice President Harris was elected, we would have been saying the exact same thing, that this was a payback year for all of the policy decisions of the past 4 or 5 years.
I've been following your thoughts on that, and I think that's largely true. And that, I mean, going into the election, I wasn't that positive. We were trying to position somewhat battle tested. Things weren't perfect. The economy or the market kept marching up. The valuations got extended, yet it kept going up. So it was an interesting, and understandably with that much stimulus, right? Kind of like taking pain meds long after you're through the surgery or whatnot. There has to be some payback. But yeah, keep going, I feel like, and we'll go from there.
Yeah. So, I mean, when I look at the overall stock market and think about where we were, I mean, coming into the year, the average analyst was looking for about 11% return for the market. We were actually looking for about a 12% drop in the market for the year, down to 5,200 is our forecast for the end of the year. And obviously just over this last week or so, we've dropped down and below that, and now we're back above that, but we still are holding at where we are at 5,200. And some of the reasons for that we believe that we would see a drop in the market is, as you said, the market was just overextended, and really it was focused on those specific Mag 7 companies. Of everybody's probably familiar with them, but if you're not, the Magnificent Seven are Apple, Nvidia, Microsoft, Amazon, Tesla, Alphabet, and Meta. Those seven companies are some of the largest. They're no longer all in the top seven, but basically they were the seven largest companies in the S&P 500, and the S&P 500 is market cap weighted. So when you think about that, they have the most value, and just those seven companies made up over 30% of the overall S&P 500 index weightings. So they mattered significantly, and they went up tremendously. And so if you had a diversified portfolio, a lot of people were probably underperforming the overall S&P 500 because of their diversification, which I would think is diversification is what you want. And to put this into perspective a little bit, if you look at the percentage of S&P 500 index members that were outperforming the index, in 2023, only 27% of the 500 companies outperformed the S&P 500. In 2024 is a little bit broader, but it was only 28%. And you think about that, this is the worst outperformance, the narrowest market really that we'd seen since 98, 99, when in 98, 29% outperformed, and in 99, 31% outperformed. So where are we today? Well, as the market has come down, we've actually seen better performance out of the rest of the S&P 500, the other 493, than the Magnificent Seven. So now, as of the first quarter, 62% of the members are outperforming the overall index. Fascinating to think about it. In fact, just looking at the first quarter, through the first quarter, the Magnificent Seven, all of them were a negative for the overall market. If you took out the Magnificent Seven, the other 493 were actually up about a little over 0.5% total. So we would have actually seen a positive quarter if it wasn't for the Mag 7. So all that to say, we think the market is still overvalued here. And moving forward here, when you look at what analysts were expecting, again, 11% returns, but a lot of that was due to a stronger economy, and on top of that, earnings growth around 10% for the year. We just don't see a very strong economy this year as payback for those poor policy decisions that we'd seen over the last couple of years. But on top of that, just not as strong earnings growth either. Probably maybe half of that to maybe flat earnings growth for the year. So put that all together, and that tells us that the market to us is still overvalued based on our models.
Interesting. And so for sure there was a pretty substantial broadening out, right? And some of the non-Mag 7 stuff
Yep.
started doing better in the value. Perhaps that's healthy, and likely to continue. I wondered if you had a few thoughts in that space, and I'm going to kind of link to another question too, not to throw too much at this, but the last 2 years have been all AI, right? Just AI, Nvidia. Then you have the DeepSeek, announcement, which came as a pretty strong shot, and the market kind of reacted for sure. I started seeing that sort of, maybe the U.S. doesn't have a total stranglehold on AI, but these massive spending by the hyperscalers, hundreds of billions of dollars on kind of an asset light type, software type company, it
Yep.
just signaled a shifting. So I look at all that stuff together, but yeah, how are you viewing that?
Yeah, in terms of a broadening of the market, I think it's a wonderful thing to be seeing. The market's just been so narrow, as we just talked about, and we need more participation. And I think especially outside of the Mag 7, and really a lot of the Mag 7 are who are investing significantly in AI, and they're the hyperscalers. And when you think about DeepSeek and everything else that's happened in that regard, where it might be cheaper now to build out these large language models than originally thought, I, to be honest, I don't think that's really going to be much of a hindrance. I think there's still going to be hundreds of billions of dollars a year in investment in AI. It's the real deal. But I think the real beneficiaries of this are going to be those other companies within the S&P 500. Maybe not tomorrow or a year from now, but over the next 5 to 10 years, I don't think there's really going to be any sector that is not influenced dramatically by AI in a positive way. I truly believe that in the next 5, 10, 15 years, once this technology really starts to be implemented and figured out the best way to implement it into these different sectors, we're going to see productivity gains like we have not seen in a very long time, and that's going to lead to higher profit margins and I think really, really strong returns for the market as well.
So, I mean, the parallel I'm drawing is back to the internet, right? We had a bubble, but later on, 10 years or however long after that, all that productivity started surfacing everywhere in life, right? Amazon and packages at your home. I don't know if you see it lining up that way or just driving towards it much, much faster, or just curious. It's really fascinating time for sure.
Yeah, I think we're going to see even faster productivity growth. And the reason being is if you look, I mean, one of the reasons the Mag 7 have done so well, I think over the last decade is that for really 15, 20 years, they've been heavily investing in artificial intelligence. And I remember when Apple surpassed a $1 trillion market cap and everybody said, law of large numbers, Apple can no longer grow. It's just not the ability, and yet they continue to grow and innovate and create and became a 2 trillion, 3 trillion, 4 trillion. Now they're back down a little bit, but a massive company. It's and I think a really good example actually is if you look at a company like say Netflix, for instance. Think back to 2000 or so. You remember those little red envelopes you get in the
Oh yeah.
mail, the DVDs, and I don't know what they made those red envelopes out of, but those things were indestructible. I mean, that in itself should have been its own company. But anyway, you get those red envelopes, and Netflix was nothing more than a really a machine learning direct mail distributor. They would distribute these DVDs and they'd get from you the ratings that you gave to the DVD, whether you liked it or not, and they built this algorithm, which was AI, built this algorithm, and that was their whole company. And it wasn't until 2007 when the internet really started to take off, but really we could start to stream on the internet, which is weird. It wasn't until about 2007 when we could actually stream stuff. That's when Netflix launched their streaming platform, and then all of a sudden they started to get way more data. People could instantly give them feedback, and they created a bigger, better algorithm and model. And by the year 2011, they actually said, wait a second, our algorithms are so good. Why are we just distributing TV and videos? We know exactly what people want. Why don't we start producing TV and videos? And so they went out into the market, and in that year was the year that House of Cards was being shopped around. And House of Cards, all the big TV networks loved it, but none of them wanted to pick it up. And the reason being was because they didn't have a pilot episode. And the way it was always done was you needed a pilot episode because maybe your producer, maybe you, the TV networks, they loved the idea, but they said, well, what about our audience? We don't know. And in that year, in 2012, there was 113 pilots that were commissioned, and it cost $400 million to make those pilots. $400 million. Only 35 of them made it to air, and only 13 of them made it to a second season. So that's only 1 in 9 pilots that made it 2 seasons or more. It cost $400 million for those pilots. Well, Netflix came in to House of Cards and they said, well, guess what? We believe in you. We've run our data. It tells us that our audience would watch this series. We don't need you to do a pilot. How many episodes do you want to do? And Netflix gave House of Cards $100 million up front for 2 seasons. I mean, can you imagine those TV producers in their ivory towers laughing at Netflix saying, these guys have absolutely no idea what they're doing? Well, that show launched, their very first show ever that they produced, launched in 2013. And in that year, Netflix was number 10 for Emmy nominations. Very first year ever. Out of all networks, they were number 10. By 2018, Netflix has either been number one or number two every single year for Emmy nominations since then. So you think about, well, why can they do that? Why are they that efficient? Well, it's because of their models. It's all AI. And that's what they built their company on. And it's an unbelievably efficient company. And now that's what's going to happen over the next 5 to 10 years to small and medium sized businesses across the board. The efficiency gains that we are going to see are going to be absolutely massive. And so I think it's an unbelievably exciting time to be alive. That's not to say that today things haven't gotten ahead of themselves, because we believe that they have. We'll have this correction or bear market, whatever we're going through now, and maybe a mild recession if we hit one, or at least a slowdown in the economy. But once we get through this, I really believe we're going to be off to the races.
That's so interesting. That's you answered a number of my questions there too. So a rough patch, recession maybe mild. People really fear that. I hear from people that term, that R word, which we haven't had for a while. But I've been doing this now 27 years, second and third generation type clients. I mean, you have to plan on a recession, every decade or so, and you have to build portfolios that go through that. But what you're saying is so interesting. I don't know if you're familiar with what's called a J curve, I guess, or is it an S curve in engineering, but sort of this, sometimes things slow down and level off, but then they hit this new peak to take off to a
Sure.
new area of growth. So that's a little bit what came to mind. So, some of what you're describing with Netflix, I think of like, similar, like the sequencing of the genetic code, right? Remember
Yeah.
Steve Jobs paid, what did he pay, $1 million or several $1 million to have this done? And then now I think it's well under $500. It might
Yeah.
be under a few $100s.
Yeah.
You
It's
can just
incredible.
do a little blood sample, or maybe they can do it from your hair. I don't know. Or you think Amazon, I mean, they started just right. They were selling books.
Yeah, you think about
Netflix.
the AI that they use at Amazon is unbelievable. I mean, it's the reason that we've been able to get, I mean, you're able to get same day shipping because of the AI that they use. They know what you're going to buy before you buy it and have it ready for you in that warehouse that's close to right
Oh
next
yeah,
to you. It's amazing to think about.
that is. Yeah, they're running those algorithms. The Netflix, that was a great example. I guess a beneficiary was we won't have all those red envelopes and DVDs going into landfills anymore. But
Yeah.
boy, so that lays out a lot. What else? What else are you and your team thinking about these days? What do you think folks should be really thinking about in terms of positioning their portfolios, or just where we're going with this economy? Just love
Yeah.
to hear any additional thoughts. Yeah.
Sure, yeah. I mean, again, I think this is a year that you just need to be more cautious, especially if you don't have a financial advisor, if you're, I think it's very important, especially in a time like today, to have a financial advisor, because if you haven't over the last couple of years, I mean, things just have kind of gone straight up, so it didn't really matter what you went into, you probably would have done okay. But and that's where a lot of people say, well, why do I need a financial advisor? But I think it's times just like today that show you why it's so important. Because if you were just all in those Mag 7 companies, you've been hit dramatically hard. Where if you've been diversified, you're probably not even down as much as the S&P 500 is, because so much of the drop has been really from those just seven companies. And so I think this is a year that you want to be more and more diversified, that you want to protect yourselves. Would I say get out of the market, move to cash? No, I wouldn't at all. I think there's a lot of ways in this environment that you can find yield. Also, there's still some areas that we believe are undervalued. You look at industrials, financials, energy. Moving forward here, I think all of those are going to do pretty well. Even just having an equal weight, if you're straight in the S&P 500, which is market cap weighted, I think an equal weight portfolio where all of the 50, or excuse me, 500 companies are equal weighted in there will perform probably better than the market cap weighted. But at some point, we needed to have a payback period, and this is kind of that period where we think we're going through right now. We're seeing some signs in the economy that things are starting to crack a little bit. I'm still I don't think we have a recession imminently coming, but I think we're getting, we're definitely seeing a slowdown. You look at employment, for example. Yes, we're still adding jobs month in and month out, but job growth is slowing. We're adding about 140 to 150,000 jobs per month on average over the last year. That's still enough to keep unemployment pretty much flat. But I think what's more worrisome is when you look at the type of jobs that are being created, it's really coming down to three main industries when you take a look over the last 2 years. It's coming down to government jobs, education and health services, which are really driven by government as well. And then lastly, leisure and hospitality, which is still recovering from the shutdowns that took place. Those three areas today, if you look over the last 2 years, so take it all the way back to January 2023, they have made up 87%, those three areas, 87% of the job growth that we have seen over the last 2 years and a couple months here. Only the rest of all jobs make up only 13% of the job growth. And to us, that's a big concern. To put that into perspective, if you go back over history, those three areas really make up usually around 40% of job growth. The rest make up about 60%. The last couple of years, it's been 87%. So that's something that's worrisome for us that we're keeping an eye on the employment front. But all in all, I mean, I think, is there a chance we don't have a recession? Sure, but I think with tariffs, what's a little concerning about the tariffs to me especially is think of the economy as the game, and we're trying to play a game, and what's tough is that the rules of the game keep changing. It doesn't matter if the rules are good or bad. I mean, obviously, you'd rather have good rules than bad rules, but if you don't have rules for the game, or if the rules for the game change halfway through, it makes it very hard to play the game. And I think that's what's being done right now with the economy. It's very hard for businesses to make decisions 6 months out, a year out, which are important to be making today if they don't know what the rules are, whether they're going to be charged a 100% tariff or 200% tariff or 0% tariff. I mean, those are real issues that companies are facing today. And the business uncertainty, I think, could have a big impact over the next 6 to 12 months here as well, which would put a little bit more weight on a possible recession, in my opinion, too.
Yeah, I think you're right. Absolutely. I mean, businesses, even people need time to plan, right? We're smack dab in the middle of tax season. It's April 14th, but people need to plan out their taxes. What is
Sure.
the stability of the code? What are the rules? How does that work if it's changing all the time? That's a concern. But you've laid out a really good case. We got ahead of ourselves. There's a payback for this massive COVID stimulus and other areas. There's massive gains that are being achieved and coming in the AI space. I loved all the points you touched on why people should have a financial advisor. I think everyone got overcommitted and figured the Mag 7 would be the only way to deal with it, to
Yeah.
invest. Not to mention people's 401ks and things like that. I manage several, and oftentimes there's not great choices, right? You maybe have your S&P 500 index or things like that, some bond choices that aren't too good, but the reality is what's in there is going to be overcommitted to that index. You don't have as much diversification opportunity in what might be your largest asset. So for your other stuff, kind of working with a partner, that's what we really are, as a sounding board. We help kind of coach, guide people through these decisions. They get to make the decision. But it's really been palpable, the value. People want to talk to someone, especially in a time of stress. And you mentioned caution, right? Kind of going cautious through this period. Just having a lot of conversations, hearing where people are at in terms of their comfort or sleeping level. Sometimes you're on a long journey, you're driving down the highway and there's some road construction, or there is just a period where you got to slow down, or even an intersection, instead of flashing green, maybe it's not green, maybe it's not red, but it's yellow. and you want to proceed through that intersection with caution,
Sure.
really with the heightened attention to paying attention to both sides of the crossroad as anybody coming through. Just really be on your game. I kind of see that as where we are, and guide a lot of folks to sometimes if we are going to go a little more cautious, we're not going to move from the left lane of the freeway all the way to the right cut across 5 lanes of traffic. We're going to signal, look over our shoulder or whatever, use the AI to tell us if there's another car there, and gradually kind of merge over and maybe slow down. I mean, those are kind of delicate, nuanced conversations. And I'm really trying to go out of my way here on a bit of a public service announcement, given the level of anxiety, and there's a lot of fear out there. There's
Yeah.
really a lot of
Big
fear, a
time.
lot of worry. People are worried their Medicare is going away forever. They're really, really concerned. So, I encourage folks, if especially clients, if you come across or know anyone who's going through these kind of sensations, or they're really concerned or worried and they want to have sort of a sounding board conversation, I'd be delighted to do it. I'll make the time if they're important to you. Just let them know how to reach me. No expectation, no obligation. I just want to kind of help people. It's sort of, in my mind, I kind of draw a parallel between what's going on. There's a mental health crisis out there, right? A lot of anxiety. People's children, just people in general, maybe post COVID more than ever. There's a lot of people going through a lot of stuff. So it's acute right now. I'm seeing it. I met with the CPA last week. He says he's hearing it from every single one of his clients. So it's out there, and most folks seem to kind of nod their head and say, yeah, I know what you're talking about. So if we can help, please let us know. But really, really appreciate you being here, Strider. Let me see if you have any closing thoughts or anything kind of salient points that haven't come up yet. But this has been terrific, and I'd love to have you back again, schedule you again. But
Oh yeah,
any
the
other?
pleasure's
Yeah.
all mine. It's really wonderful to be with you, Robert. And yeah, I just say it's tough when the market's down. It's a scary thing, but what we know is that what really drives the market over time is corporate profits, and corporate profits will grow again, and they are still growing, and we believe they'll slow a little bit, but they're going to keep growing, and AI is going to have a big impact on that. And I think when you look out, short term, be a little cautious here. But when I look out over the future, I mean, man, it's an exciting time to be alive. One of my favorite economists, his name's Thomas Sowell. If you have never read any of his stuff, I highly recommend anything he's written. He's in his 90s now, but he's written over 100 books. I mean, just an incredible guy. But one of his favorite quotes that I memorized a long time ago that I just loved was this quote that from his book. It says, "The caveman had the same natural resources at their disposal as we have today, and the difference between their standard of living and ours is the difference between the knowledge they could bring to bear on those resources and the knowledge used today." And when you think about that, you think about the knowledge that we have at our fingertips today and how knowledge is built over generations, and we continue to stand on the shoulders of those before us. And we've seen massive innovation, and we're getting to a time now where we have AI and the ability for these models to be able to process through all the information that we have at our disposal like never before in history, way faster than any human or computer could ever do it before. And you think about that smartphone, every day, I think that phone gets more and more valuable because the internet continues to grow. New people get on every single day. They bring new information, new ideas, and now we have the ability to actually process through those ideas like never before in history. You think about the cures for diseases that we are going to see over the next 5 to 10 years, the cures for probably cancers over the next 5 to 10 years. The way we do medical, I think, is going to change dramatically. There's so many answers to problems that we probably have already solved on the internet that once you put ideas together that we just couldn't do before, but now we have the ability to sift through ideas like never before. So there's a lot, I think, to be very excited about in the future. I know it's a scary time right now, but we'll get through it. payback was needed. We can't skirt through, I think, unscathed with just a little bit of inflation with the trillions of dollars of stimulus that was added and the massive deficits. A reset needs to happen. And I think we're going through that right now, which I think ultimately is going to be much more healthier for the economy coming out of this moving forward. So many people say short-term pain for long-term gain. I think that's really true. We're feeling that short-term pain right now, but stick around long enough and it's going to be a great future moving forward here.
It- that's great. I mean, thank you for the optimism. And sometimes you do have to go through that pain to get gain or autophagy. I guess there's sometimes you need to set yourself back a little bit. I've heard like if you certain trees, if you hit a nail into it, it causes a little bit of stress, but it makes them produce more fruit, or even like pruning a rose bush, right? It's a little probably uncomfortable for it, but it makes it more productive. And I love your analogy to the to the caveman times. I mean, the AI I think creates some anxiety for folks, but really some of the positive. I just had about 6 months ago. I went and got a coronary scan. It's probably the most advanced one out there. You pay for it out of pocket. It's pretty expensive, but it's all AI driven. And most folks I know don't even know about this. But the date, and this thing has only been around a year or two, but the previous generation or what was prior recommended is like 20 years old. It just does not pick stuff up the same. So to get that kind of data earlier to make improvements, over the next several decades is huge. Or even, I used to have to go study the Thomas Guide to get across town. Do you remember the Thomas Guide? Did you ever see this thing?
No.
It was
Uh,
just this book of 500-page book of every map of the city in Los Angeles. Well, now you just put it in your smartphone. So,
yeah,
and
exactly.
it'll reroute you if there's some slowdown or a traffic blockage. So it's pretty powerful if you think about how it can be used as a tool and the speed with which we're moving. So I really appreciate all that perspective, and this has been great. So thank you so much, Strider. Really
Hey, thank
appreciate
you,
you being
Robert.
here.
Really great to be with you, and we look forward to one in the near future again.
Perfect. Sounds great, everyone. Thanks for listening. Please like, share. I hope you got some good ideas out of this. Reach out if needed. Let me know privately if you have any questions. I'll try and address them on the podcast, and hope everyone has a terrific day. Thanks for being here.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities LLC, member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.